Welcome back to the finance segment of E25's YouTube channel. Today, we're doing a deep dive into a really powerful, but yeah, often misunderstood part of the financial world, private credit. Now, if you're new to E25, we're all about decoding global and local issues using sharp, data-driven storytelling. We try to cut through the noise with clear analysis and accessible commentary, really helping you see the bigger picture. So our mission today is exactly that for private credit, looking at its rapid growth, the unique challenges, and, what it all means for the wider financial landscape and maybe even for you.
That's right. We've sifted through quite a bit of material, legal analyses, financial news like the FT, even investor chats on places like Reddit. The goal is to give you a really comprehensive view what makes this market tick, the risks, which are often kind of hidden, and why regulators and investors are paying so much attention right now. Okay, so let's unpack this.
Great. So let's start right at the beginning. What is private credit exactly? It still has this sort of shadowy feel for a lot of people.
Yeah, it can seem that way. But simply put, private credit is just, well, non-bank financing that goes directly to companies. We're often talking about smaller or medium-sized businesses, the kind that might struggle to get a traditional bank loan or access the public bond markets. And this lending is mostly done by specialist funds. They raise long-term money from big investors, like pension funds, for example.
Okay, so not from banks.
Yeah.
And clearly it's not some tiny niche anymore, right? It feels like it's just exploded in the last, 10, 15
Oh,
years?
far from niche. The growth has been, well, exponential. The latest figures from the Alternative Credit Council, they put it at a massive $3 trillion industry globally. Now, most of that's in the U.S., but it's expanding really quickly in Europe and Asia, too. Just to give some context, the OECD noted it hit $2 trillion globally in 2023. And that figure, it represents about 12% of all bank loans to non-financial companies. Back in 2012, it was only 5%.
Wow, 5% to 12%. That's a huge shift in just over a decade. Was there a specific trigger for this surge? It wasn't just random growth, presumably?
No, absolutely not. You really hit on a key point there. A lot of this momentum actually started after the 2008 financial crisis. Traditional banks faced much tougher regulations, capital requirements went up, and they pulled back from certain kinds of lending, especially to those smaller and mid-market companies. That created a pretty big vacuum. And private credit funds, they just stepped right in to fill it. It's a classic story of financial innovation, really, creating huge opportunities, but also, as we'll get into, some pretty significant new challenges.
Interesting. So who are the main players driving this? You mentioned the funds themselves, like Ares or Apollo.
Yeah, those are the direct players. But you also have loads of indirect participants. Think huge pension funds, big insurance companies, endowments, sovereign wealth funds. Even traditional banks get involved, either by investing in the private credit funds or by providing lending facilities to them.
And why are these big, sophisticated investors flocking to it? What's the draw beyond just filling that post-crisis gap?
Well, for those end investors, like pension funds, it offers a few key things. One is portfolio diversification. You're getting exposure to companies maybe outside the typical public market universe. There's also a level of confidentiality, which can be attractive for really large investments. And critically, there's the potential for higher returns. Often this comes with what they call an illiquidity premium.
An illiquidity premium, so you get paid more because your money's tied up for longer.
Exactly. You're compensated for locking up your capital, often for years. It's a trade-off many institutional investors are happy to make for that extra yield. Plus, sometimes the regulatory compliance burden can be, well, a bit lighter compared to other areas.
Okay, now this is where it starts to get really interesting and maybe a bit concerning. A theme that keeps coming up in the sources is the market's opacity and illiquidity. Can you break those down for us? What do they really mean in practice?
Sure. Let's start with opacity. Think about the stock market. Public companies have to disclose tons of information, right? Financials, risks, strategy. The private credit market, it's almost the opposite. It operates largely in the dark. There's very little public info about who the borrowers are, the specific terms of their loans, have those terms been changed, how healthy are the individual loans within a fund. It's all very private, by design, really.
So it's like investing in a black box, almost. Makes it incredibly hard to really assess the risk involved if you don't have that visibility.
That's a very good way to put it. This lack of transparency definitely complicates risk assessment for investors. And it makes effective oversight by regulators really, really difficult, too. There have been attempts to push for more transparency, like some SEC rules that were proposed. But as the sources point out, those were actually overturned by the Fifth U.S. Circuit Court of Appeals. It really highlights this tension, the demand for oversight versus the industry's preference for keeping things opaque.
Right. And the illiquidity, I've actually heard it described, weirdly, as a feature, not a bug. What's that about? It sounds so counterintuitive.
Yeah, it does, doesn't it? But it's fascinating. For many inside the industry, the fact that these loans don't trade actively and there isn't much public data, that's seen as a plus. See, most investors in these funds are locked in for a set period, often several years, much like private equity. And because the loans aren't trading on an open exchange every day, there's no daily marking to market.
Meaning they don't have their prices updated constantly based on current market conditions.
Exactly. So
Yeah.
you don't see those wild price swings you get with stocks or publicly traded bonds when sentiment shifts. It creates this perception of stability. The Financial Times actually had a piece on how private credit firms actively push back against efforts to create a real secondary trading market for these loans. Like JP Morgan apparently keeps trying to buy these loans, and some firms have basically threatened to put banks in a penalty box if they even try to make public price quotes. They want to keep pricing private.
So the stability is part of the sales pitch, but it could also be, as some critics say, a bit of a mirage, hiding potential problems under a smooth surface. Sounds a bit like accounting sleight of hand.
Precisely. That's the risk. If these loans did trade regularly, their prices would fluctuate daily, just like public assets. That perception of stability could shatter pretty quickly. And the incentive for fund managers to, let's say, mark optimistically can be pretty strong, especially since their management fees are often calculated based on the fund's net asset value, or NAV. We saw a really stark example with that tech company, Pluralsight. When it defaulted, different lenders holding the same loan valued it completely differently. One marked it at 83 cents on the dollar, another apparently as high as 97 cents.
Wow, that's a huge difference for the same asset.
It really is, and shows how these inconsistent valuations, which are possible because there's no market price, can mask underlying problems. Issues can fester for a while before they become obvious.
And we've seen before what happens when things go wrong with illiquid assets. I mean, 2008, obviously, but even more recently, like the Woodford Equity Income Fund collapse in the UK. If you can't sell assets quickly to meet redemptions, it's a recipe for disaster.
Absolutely. That domino effect is a major concern. And compounding these illiquidity risks, especially now with higher interest rates, are these things called payment-in-kind arrangements, or PIK. They add another layer of complexity, often hidden, that can make those illiquid assets even riskier down the road.
Okay, PIK arrangements. What are they and why are they a particular concern in this private credit world?
Right, so PIK allows a borrower to defer making actual cash interest payments. Instead of paying cash each quarter, let's say, the interest amount owed gets added onto the total loan balance, so that grows faster. Or sometimes they might offer a sliver of equity in the company instead of cash. Now, for the borrower, this can be a lifesaver in the short term. It frees up cash for operations or growth, which is great if cash flow is tight. But the downside is clear. It significantly increases their total debt burden over time because interest is effectively compounding on previously unpaid interest. This makes a future default more likely. Now, you might think, well, private credit funds have lockups, so daily liquidity isn't an issue. And that's true. But widespread use of PIK can still undermine the overall health and the eventual returns of the fund's portfolio. It basically masks underlying financial stress until potentially it's too late to fix.
So deferred problems, essentially.
In a way, yes. Which leads to the bigger question. How does all this, the rapid growth, the opacity, the illiquidity, the PIK loans, how does it impact overall financial stability?
Well, policymakers seem worried. We've seen the U.S. Federal Reserve, the Bank of England, others voicing pretty serious concerns, haven't they? They talk about potential systemic risks because the industry is so opaque and, relatively speaking, lightly regulated. Warnings about liquidity mismatches, maybe portfolios being too leveraged.
Exactly. And what's really crucial here, and maybe a bit underappreciated, is the growing interconnectedness. Private credit funds aren't operating in a total vacuum. They increasingly rely on credit lines from traditional banks' loans to the funds often secured by the very private loans the funds hold.
So banks are exposed too.
Yes. And then you have the big private capital firms, the giant managers like Blackstone or KKR. They often manage both private equity and private credit arms. And it's pretty common for their private credit funds to lend money to companies that are owned by their own private equity funds.
Ah, so lending within the family almost.
Right. Which creates this complex web of relationships. If the private equity side runs into trouble, or if the underlying companies struggle, it can spill over directly into the private credit portfolio and potentially back to the banks, providing leverage. It's this interconnectedness that has some experts drawing parallels not in the type of asset, but in the structure and scale of hidden leverage to the conditions before the 2008 crisis with subprime mortgages.
So not just isolated pockets of risk, but a potential web that could transmit shocks through the broader financial system if something snaps. That does sound concerning.
It is. And we're already seeing some signs of stress. Data suggests credit quality might be deteriorating. Around half of the outstanding U.S. private credit loans are apparently due for repayment within the next 3 years. That's a big maturity wall coming up. Plus, many of these loans are to companies that don't have a lot of hard, tangible assets. Think software companies, service businesses.
Meaning if they default, there's less for lenders to recover.
Yeah.
Exactly. Lower recovery rates. So you have multiple layers of leverage, the borrowing company, the fund itself using bank lines, maybe even leverage at the investor level combined with potentially lower recoveries. It's a potential recipe for instability, with the risk of liquidity drying up and forcing fire sales of assets if market confidence suddenly shakes.
Okay, so given all these challenges, the opacity, the illiquidity, these complex PIK structures, the interconnectedness, it seems logical that disputes and maybe even lawsuits could become more common. The sources mention litigation risk as a sort of under the radar but important aspect here.
Absolutely. It's almost inevitable. When funds run into trouble, maybe they can't meet redemption requests if allowed, or returns disappoint investors badly, legal claims often follow. And that opacity we talked about, it's key here. Investors rely so heavily on what the fund managers tell them. So if problems emerge later, like those inconsistent valuations we discussed, or maybe the risks weren't fully disclosed or the NAV was inflated, investors can easily claim they were misled, leading to claims of mismanagement or breach of fiduciary duty.
And who's potentially liable here? Is it just the fund managers themselves holding the bag?
No, the risk can spread.
Yeah.
First, yes, fund managers are definitely exposed. Arguably, maybe even more than managers of typical stock or bond funds. Why? Because lending decisions, was the due diligence adequate? Were the loan terms appropriate? Was monitoring sufficient thing? These things can be judged against established lending standards, perhaps more easily than picking stocks. Poorly structured deals or sloppy oversight really ramps up their liability risk.
Okay, so managers are front and center. Who else?
Then you have the fund administrators. These are the third-party firms often hired to calculate the NAV, handle investor reporting, process subscriptions, and redemptions. If they make errors, say, they misprice a portfolio full of those tricky PIK loans, making the fund look healthier than it is, they could mislead investors and face claims for professional negligence.
Right, the back office isn't immune.
Definitely not. And even auditors and actuaries could get drawn in. We saw this in the Woodford fallout. Auditors faced criticism, even if not direct lawsuits initially, for not flagging the liquidity risks more strongly. In private credit, where valuation is such a murky area, auditors are under pressure. If their audits fail to catch significant issues with how assets are valued or risks are presented, they could face scrutiny too.
So even if investors are locked into these funds for years, they might still have grounds to sue later, arguing that these failures, bad valuations, poor disclosure stopped them from acting sooner or caused their losses. It paints a much less smooth picture than the stable returns narrative suggests. Okay, let's bring this closer to home for our listeners. For many people watching, private credit might be something new, or maybe something they've seen pop up on retail investing platforms like Wealthsimple offering access. What should someone consider if they're thinking about dipping their toes into this space? Perhaps through one of those platforms.
Yeah, it's becoming more accessible, which is interesting. Looking at those Reddit discussions, you see a real split. On one side, people are definitely attracted by the diversification argument, getting exposure away from just stocks and bonds. And that lure of the illiquidity premium is powerful. The idea of earning extra return for tying up your money. Some proponents will point to periods where private credit supposedly held up better than public markets, maybe even delivering positive returns when stocks and bonds got hammered.
So the appeal is diversification and potentially higher, smoother returns. But there's got to be a catch, especially for retail investors, right? What are the big warnings coming out of those online forums?
Oh yeah, plenty of skepticism too. The main worries seem to be around high management fees, which can really eat into any extra return you might hope to get. There's also huge manager risk. The success of your investment depends massively on the skill and integrity of that specific fund manager. And how does a retail investor realistically vet that, given the lack of transparency we've been talking about? And that leads to the third big point. Just a general lack of good, solid due diligence material available for many retail offerings. We saw comments on Reddit where users were saying hard pass on certain products, precisely because there was so little information disclosed. One person said something like, no serious investor would touch this without proper due diligence material.
So how do you pick a good manager with fair fees if you can't see under the hood?
Exactly. It's a major challenge for individual investors. And this connects back to the valuation issue, raising another big risk, what some call valuation contagion.
Mm.
Imagine taking these inherently illiquid, hard-to-price private loans and packaging them into a fund structure for retail investors that promises, say, daily or monthly liquidity.
Uh-oh, I can see where this is going.
Right. What happens if the real underlying value of those loans suddenly needs to be marked down significantly, maybe because of defaults or just changing economic conditions? If investors see the NAV dropping sharply or even hear rumors of problems, it could trigger a credibility run, everyone trying to pull their money out at once from a structure that can't sell the underlying assets quickly.
It sounds like a potential mismatch just waiting to happen, a house of cards, as you said earlier.
It could be in poorly structured products. That promise of liquidity backed by illiquid assets is a classic financial fragility.
Okay, so it's really clear that while private credit offers some genuine opportunities and has undeniably reshaped parts of the lending market, it's definitely a double-edged sword. The structural issues, the opacity, the illiquidity, the valuation challenges combined with its sheer size now make it something to watch closely, both for the financial system and for individual investors. It definitely feels like a market ripe for more scrutiny, especially as we inevitably see more loan defaults, which, let's face it, are a timeless part of finance.
Absolutely. And this leaves us with a really important question for you, the listener, to think about. As private credit keeps growing and as it potentially becomes even more accessible, how should regulators strike that balance? How do they weigh the industry's strong preference for keeping things private and opaque against the growing need for transparency, stability, and ultimately investor protection? It's a tough needle to thread.
It really is. Well, we hope this deep dive has given you a clearer, maybe more nuanced view of the world of private credit, helping you cut through some of the noise around this booming market. If you found this discussion insightful, please do take a second to hit the like button, maybe share it with others who'd find it interesting, and definitely subscribe to E25's YouTube channel. We've got more deep dives coming up, decoding the topics that shape our world. Thanks so much for joining us today.